You know, you never can tell if everything's been shaken out, but we believe that over the sort of the near term, we will get through this, and that's why we're staying overweight in global equities now.
What gives you that confidence that we're going to get through it and that stocks are the place to be?
Sure. Well, first, let me tell you what we've been observing. As you mentioned, we have a very large global business, and we've been talking to clients around the world. And, you know, when we talk to clients out in Asia, we're seeing equity investors rotate somewhat out of growth stocks, but certainly no panic. We're seeing fixed income investors really starting to look for opportunities in Asian credit right now. In Europe, we have some very sophisticated investors. They're even looking to sell volatility here. They're certainly not panicking. And in the United States, we're seeing some of that rotation out of growth and into value stocks, which typically would not be doing well if this was really the end of the cycle. But what I think this global picture highlights is that the rest of the world has already sold off. I mean, they've been going through a lot for all summer long, and so for the rest of the world, to give you that global perspective, what's happened today in the United States, or in the past few days in the United States, is a little bit of a realignment, but certainly not enough to upset the strong things we see in terms of global growth and what still we believe will be a strong Q3 earnings season.
Hey, Mark, we've seen a lot of signs that fund managers are overweight U.S. To a degree we haven't seen really since 2015. If that changes, where do they go, given some of the ongoing risks that, say, J.P. Morgan is outlining today about the rest of the world?
Yeah, well, I think that certainly the allocation to U.S. has come down a little bit. And for us, I think we look at a variety of countries around the world. For example, we look at Canada now. They can benefit from some economic strength. It's a relatively cheap market, and they can benefit from oil. APAC the Asian markets have really been hit, especially China, and so we still have allocations there. So when it comes to equities, I think not expecting the U.S. to continue to outperform global equities and then playing it through just the broader equity index is a better way to go from this point forward.
Mark, what's your take on this debate we're having about whether the market agrees with President Trump on the Fed, that they're moving too fast and they should cool it down a little?
Well, I think that the interview that Steve did this morning with President Evans really gets to a lot of this debate. And because what President Evans was saying was that, we're comfortable with even moving up above the neutral rate at some point, given that unemployment is so low and they remain data dependent. The issue with that is that there are so many other things that investors focus on, like tariffs. And so if the Fed is watching a certain set of numbers and then they get broadsided by tariff concerns, which are beyond their control, and an international factor, they're going to find that out at the same time the market finds that out. And that's why I think what you said about some of the earnings that have come out this week, just how closely investors want to see if that tariff impact is going to start to already hit now for the Q3 earnings.